Hello, everyone. Fee-only financial planner Dieter Scherer here from RealizeYourRetirement.com. Today I'm going to review the Allianz MasterDex X fixed index annuity with simple income 3 rider. As a fee-only financial planner, I don't receive commissions for financial products, nor do I sell annuities. A new client asked me to review this annuity, so I thought I'd help some of my blog readers out and post this review online. Like my other review, this video is a companion to a blog post. In the post, you'll find all of the jargon associated with this annuity, like accumulation value, lifetime income base, and so forth, so I'll try not to be too redundant. I'm just going to go over some of the more convoluted concepts that you need to know so that you know how this annuity really works. After that, I'll get into my Excel model, and you can follow along as I break down each piece of this annuity and the returns you might expect over the next 30 years. This is never really done during the sales process that many investors go through, and I think it's important to see a breakdown of how this annuity may play out for you by using the hard data we have and projecting it into the future. You may have seen other reviews for this product out there, but I like to think mine will be a little different. Unfortunately, a lot of the reviews for this annuity are either glowing reviews or harsh criticisms, but neither side really breaks it down and lets investors decide for themselves. So today I'm here to try and fill that void by providing you with some unbiased information about this annuity. So, please review my legal disclosure, and then we can get started. This review is neither a recommendation to buy nor a recommendation to sell an annuity. I am not compensated for this review. Allianz has not endorsed this review in any way. Before purchasing any investment product, you should perform your own due diligence by reviewing the prospectus and other materials for the product. This review should not be considered personalized advice. Please consult a properly licensed professional should you have a specific question about how this product can fit into your individual financial circumstances. All names, trademarks, and materials used for this review are property of their respective owners. The Allianz MasterDex X is a fixed index annuity, which means that it has a formula that is linked to one of the following indexes: the S&P 500, the S&P 500 Select, which is a smaller portion of the S&P 500, the NASDAQ 100, Euro Stoxx 50, and a blended index, which is 35% Dow Jones, 35% Barclays, 20% Euro Stoxx, and 10% Russell 2000. Today we'll be using the S&P 500 because the data is widely available and it has the longest record of historical returns. A lifetime income rider is also available for an additional fee of 0.75%. The rider for the MasterDex X that I'll be reviewing today is called the Simple Income 3 rider. Most investors will be purchasing this annuity for the lifetime income benefits, so this will take center stage in the annuity today. Also, like most fixed index annuities, this MasterDex X offers a guaranteed value, so you cannot lose any of the money that you invest into it, so long as the company's financial strength is secure. A fixed index annuity doesn't let you receive 100% of the returns of the index it is linked to. Once you have selected the index you'll be using, you must decide on the type of crediting method. There are 3 types of crediting methods available for you to choose. Your choices are monthly sum, monthly average, and annual point-to-point. Each type of crediting method has a different way of reducing the returns of the index, so you must choose which one you think is best. I'll go through each of them on their own slide. Here we have monthly sum crediting. The documentation with the contract uses the year 2009 as an example, so I'll do the same. Here you can see the S&P 500's return in dark blue, and then the interest that would be taken into account with the monthly sum formula in light blue. The monthly cap is 1.8% for gains, and not limited for losses. What this means is that every time the S&P 500's gains are over 1.8%, Allianz only takes into account a gain of 1.8%, but they will take into account a full 11% loss like you see in February. The losses and gains are then summed up for the year to give you the interest credited. When you simply sum the gains and losses of the S&P 500's gross return, you'll get 23.58%. However, if you add up the returns using Allianz's formula, the sum is a negative 7.14%. So you would have received no interest for the year. As you can see, using a formula that limits upside gains can cause 1 or 2 bad months to wipe out any gains you might expect for the year. So here we have 2009 again. This time we're using the monthly average method of crediting. Here, we take the monthly average value of the S&P 500, which turns out to be 1,015, and subtract the beginning value of 948. And then we divide it by the beginning value of 948. This equals 7.04%. Now, 7% sounds pretty darn good, but we're not done yet. We have to reduce this return by 4.5%, which is what is called the spread. Well, 7% minus 4.5% gives us 2.5%, which is less than we would have liked, but it is better in the year 2009 than the monthly sum averaging. This can change year to year. One method may be better than another, but this is the case for 2009. Finally, we have the annual point-to-point crediting method. This method looks at the gross return of the S&P 500, which is determined by the formula above. The gross return of the S&P 500 is 26.4%. But the current cap for this formula is 3%, meaning that if you use the annual point-to-point crediting method, you cannot receive more than a 3% interest credit in a given year, no matter how much the index rises. Now that we've covered the crediting methods, let's get to the simple income rider. Alright, now that we've covered most of the important rules of the MasterDex, let's get started on the meat of this review. Here we have the return calculations for the S&P 500. As you can see, the data goes back 60 years until 1950. Here we have the value of the index. Then here we have the gross monthly return of the S&P 500. Now I wanted to be thorough in this review, so I've built all 3 crediting methods into this model. If you look up here, we have the caps and the spreads for this annuity. The monthly cap is currently 1.8%. The monthly average spread is 4.5%, and the point-to-point cap is 3%. In this row over here, we have the capped monthly rate of the S&P 500, which is taken into account in the monthly sum formula. So the highest return that can be credited in any given month is 1.8%. As you can see, 6% turns into 1.8%. 4.72% turns into 1.8% because that's the monthly cap. But the losses that are included in this portfolio are the actual losses of the S&P 500. As you can see down here, we have like negative 3.65%, negative 1.96%. So that drags the monthly sum average down. Over here, we have the gross annualized S&P 500 returns. And for 1950, the return was a whopping 27%. But because over here, the point-to-point annual crediting formula is capped at 3%, the most we can receive in any given year is 3%. As you can see in 1950, that 27% was capped at 3%. And finally, over here, we have the monthly average method. For 1950, it returned 3.6%. And as you can see already, the formulas significantly reduce the returns of the index. So, for illustrative purposes, I have the value of the initial investment when grown at the gross returns over here. Then I have the value net of fees over here. And finally, I have the value of the investment if grown using the 3 crediting methods over here. So, as you can see, each of these methods gives us only a fraction of the returns of the S&P 500. But we also don't have the risk associated with the index. So let's scroll all the way down to the bottom here and check this out. So over this 60-year time period, a little over 60 years, but over this 60-year time period, the S&P 500 would have grown that initial $100,000 investment to a little over 8.3 million by November, but if we are going by last year, about 7.7 million. And after fees, it would have grown to 4.8 million. Whereas each of the crediting methods over here, as you can see, would have grown to just a fraction of the S&P 500, less than 10% of its value. And because of this, I would never recommend a fixed index annuity for growth, but most people buy annuities for the downside protection anyway, so this is somewhat of a moot point. All right, so up here at the top, I have some cool Excel wizardry that I've programmed in. If we change the method over here, like currently I have it on S&P 500 gross returns. So the 60-year gross return of the index comes out to 7.29%. Net returns turn out to be 6.54%. And over here you'll find some of the other portfolio measures: Sharpe ratio, standard deviation, and the risk-free rate. The risk-free rate is the rate of return on the 13-week Treasury bills that are issued by the U.S. government. The finance community generally considers this to be the risk-free rate because it's not subjected to too many risks, and it's unlikely that the government will ever default on its debt because it can just simply print more money. Now that has dire consequences for inflation, but debt holders for the United States don't have to worry that much. Now, over the past 60 years, the risk-free rate has returned about 4.75% each year. And over the last 10 years, it has returned about 1.65% each year. Now, if we look over here at standard deviation, we can see the risk in the portfolio. Standard deviation is a measurement of how much a security moves. So how much of the return of the security will vary between years. Here we can see that the S&P 500's looks quite high, which it is compared to other asset classes like bonds, but it's considered in a normal range for stocks. Now the Sharpe ratio over here might be something new to most people, and it's the rate of return net of fees minus the risk-free rate divided by the standard deviation. This ratio is a measurement that shows us the risk-adjusted return that you'll see. So it tells us the percentage returns we are compensated for each point of risk we take on. I want to point out that here the Sharpe ratio is positive for each of the time frames I measured. Now if we look at each of the other crediting methods in turn, we'll see that each of them has a negative Sharpe ratio. But let's focus on monthly sum because it has the highest 60-year return, just to be fair. The standard deviation of each time period is quite small compared to the S&P 500, but the returns you receive are much lower. The standard deviation here comes from the fact that the returns for the crediting methods are not constant, and they vary from year to year. just like the S&P 500. But the returns don't venture as far above zero, and they never go below zero. So they're in a smaller band, which leads to a smaller standard deviation. Well, when we calculate this out on the left over here, we see that we have a negative Sharpe ratio for each of these time periods. And basically, this means that the more risk you take on, the less return you'll receive for the risk you take on. A Sharpe ratio of 0 would indicate an investment in Treasury bills. So, on a risk-adjusted basis, we see here that Treasury bills offer us a better risk-return trade-off than this guaranteed annuity. As we go forward, I'll be using the 60-year return in the model for the annuity. So I want to use the highest return from the crediting methods, the monthly sum return, which is a return of 2.7%, to just give you a best case scenario. Now that I've covered most of the back end, let's get started on the modeling of the annuity itself. Alrighty. Up here on the left, we have the assumptions. To make things easy to follow, we have an initial investment of $100,000 and a 6% bonus, which comes out to $6,000. Here we have the distribution rate of 5.5%. For this review, I've assumed that the investor is age 65 when they purchase the annuity and is seeking income for a single life expectancy. So after 10 years, when they begin withdrawing their funds, they would fall within the 5.5% age band. Now, there are 4 different account value types. Each is separate from the others, and they guarantee different things. The lifetime income base is the initial investment of $100,000 plus the 6% bonus plus 6% of simple interest each year. After 10 years, this equals $166,000. The guaranteed minimum value is 87.5% of your initial investment of $100,000, grown at a fixed rate. No matter what, you cannot receive less than the guaranteed minimum value minus withdrawals. Allianz has elected to grow the guaranteed minimum value at the minimum that is legally required by the states. In Maryland, this minimum interest requirement is 1.85%. The accumulation value is the more common value that you associate with investments. This is the initial $100,000 plus the 6% bonus. It is grown using the rate of return from one of the crediting methods. In this case, the monthly sum crediting method, minus the expenses. So 2.7% minus 0.75% equals 1.95%. Now the surrender charge over here is the fee that Allianz will charge you if you withdraw your funds within the surrender period. This is used as a way to recoup the commission they pay to their salesperson and to make a profit on you even if you don't stay in the product for very long. The surrender value over here is the $100,000 initial investment minus the surrender charge, minus the unvested portion of your bonus. Now, because your bonus needs to be vested over time, you only receive the rights to 10% of the bonus, or $600, each year for the first 10 years. If you terminate your annuity contract immediately after the initial grace period, you would lose $10,600 on your initial investment, which is shown in the gain-loss column. Now, the gain-loss column is the sum of the surrender value, if it is greater than 0, plus the total income received. So back up to the top left. The distribution rate is 5.5% of the higher of the accumulation value or the lifetime income base. Because the annuity only returns 1.95% each year, the accumulation value never rises above the lifetime income base in this example. So the annual income is steady at $9,130. Over here on the left, we have total income received and the net total income. Net total income is the total income you have received so far minus the $100,000 you paid for the annuity. So, if a retiree buys this annuity on his birthday at age 65 and waits 10 full years to begin withdrawing income at the beginning of year 11, the return on the surrender value of the account will be 2.48%. But the return on the lifetime income rider is still very negative because it is yet to provide any income. After we begin receiving income, the rate of return on the lifetime income base starts to increase, while the rate of return on the surrender value starts to decrease. This is because once you start withdrawing funds, the amount of money that is gaining interest in the account is smaller, so there is less money that can compound the return over time. Finally, after 21 years from the initial purchase and 10 years after beginning to receive income, we break even, having received our original $100,000 back, plus a little bit extra. It's at this point that the return on the lifetime income rider becomes positive, because it's based on how much income we have received from the annuity. Now, I don't have the data for 65-year-olds in front of me, but according to the Center for Retirement Research, a 62-year-old man has a 38% chance to live until 85. And a 62-year-old woman has a 51% chance to live until age 85. So most people have less than a 50-50 chance to live until they break even on the income rider for this annuity. If we continue mapping the returns out even further to 30 years after purchase, the income rider has a 2.03% rate of return, and the surrender value has been exhausted, having decreased to a 2.18% return in year 25. So I think it's a bit unfair to advertise this annuity as having a 100% participation in the market. Most people don't know what that means. And then, on top of that, offering a 6% guaranteed return. I think under the best circumstances, and being able to predict which crediting method will give us the best return, which is really hard to do looking forward, they should sell this annuity as a 30-year guaranteed rate of return of 2.03%, which isn't much better than the guaranteed FDIC backed return of a 5-year jumbo CD, which according to Bankrate.com has, as of today, November 14th, 2012, a 1.85% rate available on a $100,000 investment. I think it's really tough to see how these complicated products work until you see them broken down like this. There are so many moving parts, it makes calculating this by hand or via calculator an absolute nightmare. Now, I don't think the salespeople that sell these are bad people for selling this annuity the way they do, by touting market participation without the downside. I just don't think it's completely transparent, and many investors might think twice if they saw the annuity broken down like this during the sales process. Well, now that you've seen it broken down like this, I think you can find a better 30-year investment than the MasterDex X. Laddering bonds or CDs, or even a fixed annuity, might be a better solution for you. I'm sure there are other fixed index annuities that may be better than the MasterDex X if you are still committed to buying a fixed index annuity. If you want more information about how the investment strategies I believe a retiree should use, you can sign up for my free video series called Off Wall Street Wealth by going to offwallstreetwealth.com. Or, if you're reading this on my blog, you can simply fill out your name and email below to get access. If you know of any of your friends that might find this useful, you can also share this annuity review with them by using the social sharing buttons at the bottom of the blog post, or by using the share this via email. I'm sure they'd be grateful to see just how a fixed index annuity works. Well, that wraps up today's review. I hope this review of the Allianz MasterDex X fixed index annuity with simple income 3 rider has provided you with a lot of value. Let me know in the comments if you have any questions or would like me to review another annuity. Thanks again and have a great day.